And that is the closing bell this Monday, March 7th. We've made it through yet another volatile day on Wall Street with all three major indices sharply in the red. The S&P 500 down nearly 3%. The Dow Jones Industrial Average now down more than 800 points or about 2.4%. And the Nasdaq Composite, the biggest laggard during today's session, down 3.6%. But let's now bring in our market panel to help make sense of the moves that we've seen over the course of the past day. Scott Clemons is Chief Investment Strategist at Brown Brothers Harriman, and Robert Cantewell is Upholdings Portfolio Manager. Scott, I'll start with you. Just taking a look at the price action and the volatility that we saw in today's markets, do you think this was an overreaction to the downside, or does this move make sense to you given the uncertainty that we still have on the geopolitical front especially?
It makes sense in a couple of contexts, the first and the most obvious of which is what's populating headlines today. But if you take a step back and broaden the picture out a little bit, it's worth reminding ourselves that this market rally that began in the dark days of late March of 2020 went all the way through January 3rd of this year without any real correction to speak of, certainly no 10% pullback or anything of that nature. What we're seeing and have been seeing since the beginning of this year is the reminder that volatility is a feature of financial markets. It's not a bug. It doesn't always need a reason. There's a very good reason being presented today, obviously. So this, within the context of larger market trading terms, makes all the sense in the world, particularly when you layer the geopolitics on top of it.
So then, Scott, I want to bring you in here then. In terms of the companies that you would really back here, when you look at the volatility, and we don't know how prolonged it's going to be, you have the interest rate hikes, you have inflation, you have the Ukraine-Russia crisis. What companies are you watching? Where do you see the best investments right now?
Well, if that question's to me, I'll be brief. It's really across the board. One of the features of the market last year was that the rally we enjoyed was pretty narrowly led. There were plenty of companies that got left behind in that rally. So our portfolio managers and analysts are finding opportunities that have sold off far more than the market has pretty much across the landscape. Energy might be an exception because energy obviously has moved in the opposite direction this year. But other than that, there are a wide breadth of opportunities on offer.
Okay, and so, Scott, when we think about the opportunities that are out there right now and perhaps those that you would be stepping away from, because I think that's where a lot of this rotation also comes into play, is where investors are trying to mitigate some of where they still do have exposure on the table. Where would those places be?
Well, I would be very nervous of energy in here, and not only because of how well it's done, but as a reminder, geopolitical unrest like this can obviously lead to a spike in oil prices, and they can be quite scary, as the spike in oil prices are today, but they can also resolve rather quickly. We're seeing a lot of energy companies that have run away far on the upside, anticipating not just elevated prices of the underlying commodity, but extended elevated prices. And whereas that is certainly a possible outcome of this, if this prolongs and these disruptions continue, oil could go right back down as quickly as it went up if there is a quicker resolution to these unrests in Ukraine than markets currently anticipate. We would also avoid and the larger capitalization technology stocks, and I know a lot of them have come off a long way. You observed, Jared observed that Facebook has halved in value since its peak last year, but that's still an area that we're quite leery of. What we like are the good old-fashioned consumer stocks, both discretionary and non-discretionary, coupled with information services and a little bit of technology services as well. That's where we're finding most opportunities at present.
Robert, speaking of energy, oil prices are soaring as the Fed prepares to start raising interest rates. Now, in the past, this combination of events has coincided with recessions. Is this time going to be different?
Well, every time is different. And I might actually be buying some of the stocks that Scott is talking about selling. When you get into market situations like this concept of flight to safety is exactly the wrong moment to be buying the safe stock. Even Buffett cut his buybacks in half in the past 6 weeks. So the year to buy Berkshire was last year. It's not now. Now's the time to go after a lot of those technology stocks that have gotten completely reamed over the past couple of months, because as scary as it is, that's where there's a lot of opportunity. And the market sank like a rock today. And what we're seeing is, as folks are trying to parse through all the data, is the more growth that you have that is coming from outside the United States, the more your stock is getting pounded. And that's actually a little bit of a reversal of where we've been, because a lot of the fastest growing companies inside the S&P 500 were actually generating more of their incremental growth from outside of the United States. And that's why that this event is causing so much turmoil in the market, is because one of the leading growth engines for so many US domiciled companies is now at risk.
And Robert, just to follow up, with an eye on inflation, you've identified Visa as one of the companies to own since it benefits from inflation. Which other companies or sectors would you also add to that list?
Now, Visa is an easy one. We've been spending more time on companies with sub $50 billion market caps. So the Roblox, the Datadogs, a handful of these companies that had really high-flying valuations last year, they're still phenomenal growth companies that are generating free cash flow and have tremendous futures ahead of them. There's never been a better time to buy Meta and Facebook's platform. Everything we do is transparent. We manage the Compound Kings ETF, the first actively managed fund of its kind, and all of our holdings with all of our position sizes are published daily. So you can always see what our top ideas are.
Rob, I just want to stick with you for a hot second, because it comes back to something that you mentioned in the difficulty of trying to call a bottom at this point in time. And as of right now, you've got state officials, local officials, even some federal officials that are trying to untwine the amount of investment that Russia even has in some pension funds here in the U.S., in some of just the financial capital that has been thrown around in the infrastructure. And so with that in mind, if there is that untwining that takes place, how much more of this move to the downside could we anticipate because of that forced selling activity that may be brought about?
It's wild. I mean, certainly in my lifetime, I've never seen a country slowly becoming a Cuba or becoming a North Korea in front of our eyes, being closed off from the world economy. Now, fortunately, Russia's share of the world economy has shrunk massively over the past 25 years. And the reality is the world, Visa and MasterCard put their numbers out there, 4% of revenue in Russia, 1 to 2% in Ukraine. So you're talking about a 5 to 6% evaporation of cross-border activity that the economy was enjoying from the existence of that being a global player. And if it gets completely shut off and become its own island, frankly, 5 or 6% of the world is not something that is really going to hold the rest of the world back from growing. And now you're looking at prices that are a lot cheaper to buy into. And if you look at past crises of the past 25 years, the 9/11 attacks, the war in Afghanistan, the invasion in Crimea, every single instance, the NASDAQ was up double digits 100 days or so after the beginning of the crisis. So we look to moments like this as the world's going to look really different a year from now, 2 years from now, 3 years from now. And there's really no reason to over extrapolate from the moments, the things that we're reading about day to day.
All right, we do thank you all for your insights. Thank you so much. Scott Clemons there, Chief Investment Strategist at Brown Brothers Harriman, and Robert Cantewell, Upholdings Portfolio Manager. Thank you guys so much. All right, we're going to bring it back to our very own Jared Blickery for his final thought on how the day closed. Jared?
I just wanted to continue to the discussion here about the bottom that we're all looking for in the market. Is it already there? And you can see in the Wi-Fi Interactive, we have a year-to-date chart of the S&P 500. Just had one of the worst days of the year yet again, and looks like we're heading down tomorrow to test these lows. Doesn't have to happen, but what I do like about the situation as opposed to in prior weeks is sentiment has really turned bearish, and that's what you want to see in a market turn. Doesn't mean that we're not going to take out these lows. It doesn't mean that we're not going to take out 4,000, but think about the news flow here. We have a Federal Reserve meeting next week, probably going to have a little bit lighter touch than everyone expects. We also have a CPI print coming out or more inflation data, and we also have a number of other things that are contributing to the news flow. Just think if the tide were to turn in the Ukraine-Russia conflict, what that would bring, what those headlines would bring to the market. Now, what are people going to buy? I think they're going to buy some of those quality beaten down names. You look in the software space, 1 year's performance, pretty bad for a lot of these guys, especially when you take it on a 3-month basis. So I think a lot of these names are going to get scooped up here. It could be a buying opportunity. Doesn't mean that we couldn't have materially lower prices. And that's, in fact, if World War III does erupt, yeah, the Dow's going to go down 10,000. But in the current environment, it looks like we're trying to find a bottom right now. Bottoming is a process, takes a little bit of patience, easy to get scared out. So take that for what it's worth, guys.